So you've got this world-changing idea. You've even managed to pull together a brilliant team. But now you're staring down the biggest challenge of all. How do you get the cash you need to grow without giving away the very company you're trying to build?
I mean, that's the big question, right? It's the one every single entrepreneur has to answer. For decades, the solution was kind of painful. It often forced founders to choose between their vision and their ownership. But a different path has opened up. And to really see it, we need to understand the problem it was built to solve.
To get a handle on the power of this alternative, we actually need to jump back in time to the very start of the tech boom. We got to understand the brutal trade-off that defined the startup world for years.
Okay, so let's paint a picture. It's Silicon Valley 1980. And believe it or not, it was less about code and way more about cherry orchards. The first wave of tech companies, we're talking semiconductors, computer hardware, medical devices, they were incredibly capital intensive. They were building physical things, which meant they needed a ton of really expensive equipment. And the only way to pay for it was to sell off pieces of the company.
All right, so this is you at the very beginning. As the founder, you and your early team, you own pretty much everything. The whole pie is yours. This is the dream, right? But then you need cash. You got to buy those servers, that lab equipment, you need to build out your first data center. So you go out and raise your first round of venture capital. And boom, just like that, a massive chunk of your company is gone. Sure, you've got the cash you need to grow, but the price you paid was a huge piece of your ownership. This is that trade-off. And with every new round of funding, your slice of the pie just keeps shrinking. This is what we call dilution, and it's the absolute heart of the founder's dilemma. You're building something amazing, but you're owning less and less of it with every single step you take. Now, you might be thinking, hey, why not just go to a bank? Well, banks were not the answer. See, banks want to lend against hard assets, things that hold their value. Or they want to lend to companies with predictable, positive cash flow. But early-stage tech companies? These startups, they're just burning through cash, and their expensive equipment often becomes obsolete almost overnight. It just wasn't a good fit at all.
Okay, so banks are a no-go, and venture capital is super expensive in terms of equity. Entrepreneurs desperately needed a third option, a new kind of capital designed just for them, for their unique situation. And that's where venture debt comes in.
So what is this stuff exactly? Well, you can think of venture debt as a layer of capital that comes in right alongside venture equity. It's not there to replace it, it's there to supplement it. It's basically a loan designed to give a company more time, more runway to hit its next big milestone before it has to go out and raise another expensive round of equity.
Let's break it down like this. Venture equity is like rocket fuel for massive growth, but it costs you a huge percentage of your company. Venture debt is different. Its main job is to stretch your runway so that you can raise your next equity round at a much higher valuation, which means way less dilution. So instead of paying with a massive slice of your company, you're paying with interest on the loan plus a small equity option called a warrant, and we're going to get into that right now.
Okay, so that's the what, but how does a venture debt deal actually get put together? It really all breaks down into two simple key parts. First up, you've got the loan itself. It's usually paid back over 3 to 4 years, and it's flexible cash you can use for pretty much anything, hiring, marketing, you name it. Second, and this is super important because it's the lender's reward for taking the risk, is the warrant. A warrant is just an option to buy a tiny amount of stock in the future, but at today's price. This is how the lender gets to share in the awesome upside that they helped create. Now, you should really think of a modern warrant as a financial Swiss Army knife. It's a tool with all this flexibility built right in. It's engineered to protect the lender from market volatility, like if the company's valuation drops in a future funding round, what they call a down round. This gives them the power to exercise their option when it makes the most sense, preserving the value of their investment, no matter what the market is doing.
Look, theory is great and all, but what does this actually look like in the real world? Let's take a look at maybe the most famous example of all time, even though very few people know this part of the story. This one quote just sets the stage perfectly. Listen to that. We're not talking about saving a couple of percentage points here and there. We are talking about 20% of the entire company. A truly mind-boggling amount of value was saved because of venture debt. When Facebook first decided to use venture debt, it was just a university-only product. It wasn't even the first social network. MySpace and Friendster were already out there. And its valuation, can you even imagine? Its valuation was a measly $5 million. So over a series of small deals, the company took on a little over $2 million in venture debt. And that capital, that was everything. It was the bridge they needed to grow like a weed and hit the milestones they had to hit to raise their first major institutional round of capital at a much, much higher valuation.
So that 20% of equity that was saved, by the time Facebook went public, it was worth about $20 billion. Just let that sink in for a second. $20 billion in value that stayed in the pockets of the founders and the early investors, all because they used a couple million in debt at just the right time. It's insane.
Okay, so that's the power for a founder. It's a game changer. But what about for the investors who are actually providing this capital? How does this strategy perform, especially when the markets get all choppy and weird? Well, it all comes down to something called the J-curve. So in traditional venture capital, you invest your money and then you wait and wait. It can be 10, even 15 years before you see a single dollar back. That deep initial dip you see, that's the J-curve. Venture debt is completely different because those loans start getting paid back almost right away. Investors start seeing cash distributions in year one. It's a much, much shallower J-curve. It provides steady returns from loan payments plus the upside from the big exits. And for a founder, that investor stability is absolutely key. It means this capital is way more likely to be available, even when traditional VC money dries up.
And look, this isn't just theory. This is what happens in the real world when things get tough. Over the last few challenging years, cashback from traditional VC funds has hit a 15-year low. But at the exact same time, venture debt funds just kept on returning cash to their investors from all those loan payments. Look at this. A leading fund returned $500 million in just 3 years. It's a model that really proves its worth through good times and bad. So let's bring this whole thing full circle, back to where we started. Back to you, the founder, and that fundamental dilemma of how to grow versus how much you own.
At the end of the day, it really comes down to this simple but incredibly powerful idea. The entire purpose of this financial tool is to help founders keep more of what they have worked so damn hard to build. It's not about replacing equity, but about using it smarter. So it really leaves you with one final question to ask yourself. When you're building something from scratch, capital isn't just money, it's the lifeblood of your entire vision. But not all capital is created equal. The question isn't just about how much money you can raise, it's about what that money will truly cost you in the long run.